Welcome to Line of Sight, Clearway Capital Solutions podcast series, where we talk to service providers, stakeholders and industry bodies that can assist fund managers and general partners in building their businesses in Australia and New Zealand. This podcast is for educational and illustrative purposes only and does not constitute and should not be relied upon as financial advice. The podcast will be provided to listeners on the basis that they are wholesale investors only within the meaning of the relevant sections of the Corporations Act.
Today we are joined by Peter Warren from Finura Group. Finura Group is a specialist wealth management technology consultancy helping advice and financial services businesses select, implement and better use technology. Its services include technology strategy, outsourced CTO support and implementation assistance with a focus on simplifying systems and improving advisor workflows.
Peter, are platforms quietly becoming powerful distributors in Australia, even if they are not distributors in the traditional sense?
Yeah, I mean, quiet's an interesting word. I think it's not so quiet now. I think everyone's really woken up to just how influential platforms are. And whilst I don't think they necessarily, exercise any direct control of distribution, they are powerful gatekeepers in the same way that Apple is a powerful gatekeeper to software applications, and Google are a powerful gatekeeper themselves. So that's how we tend to think of platforms from a technology perspective, and the way they effectively do own so much of the advice infrastructure that people rely on today.
Does that mean that platform access is becoming perhaps more important than advisor access?
Yeah, it's really interesting. As we've worked with hundreds of advice businesses across Australia over the years, and I would say now more than ever, the focus on efficiency and what technology can do for practices is always in the top one or two highest priorities of a business. And so I think practices are now increasingly saying to us that they're looking to become more monogamous with the platform that they use. Even our Finura Health Check tech benchmarking data suggests that the fewer platforms a practice uses, the more efficient they are across all their advice processes, is sort of validating that. And so I sort of feel from that perspective that if you are distributing funds and you're not in those core platforms that are commanding the lion's share of advisors' businesses, then you are at great risk of not being, not accessing those advisor distribution. And the main reason for that is that, for advisors to access funds that are off platform, it creates a whole bunch of inefficiencies all the way through the advice process that needs to be managed. So you'd want to have a pretty compelling story to sit outside of that platform infrastructure. Yeah. So I guess I'm sort of interested, from your perspective, because, distribution is a pretty expensive business for fund managers. And as I understand it, margins are getting thinner and thinner as asset-based fees compress. Is this going to be a real challenge, you think, for the economics of distribution?
Yes, I think it is, Peter. The economics are shifting from a relationship-led model towards a more workflow-led model. Fund managers are no longer investing only in sales coverage, roadshows, entertainment and travel. Increasingly, some of the distribution spend is moving into technology, data and implementation. Fund managers need high-quality data feeds, a strong reporting infrastructure, platform integration that is as seamless as possible. They also need to think about things like portfolio analytics, managed account compatibility, and the broader support they provide to advisors. So that changes both the cost base and potentially the return you get from distribution activity. Does that mean that distribution becomes more expensive? Not necessarily. I think it means the cost profile changes. As AI improves, some of the traditional costs of distribution should become more efficient. Meeting preparation, follow-up, segmentation, and content specialization are all areas where technology can probably reduce the amount of manual work involved. But at the same time, we're seeing new costs emerging around platform access, data quality, reporting, and making sure strategies can actually fit into the systems and portfolio structures advisors are using. So the more economic measure the more important economic measure may increasingly become conversion efficiency, how effectively you turn advisor interest into implemented assets. And I think that has implications for where managers spend their distribution budgets. Being visible everywhere may become less important than being well positioned within the right advisor ecosystems. Ultimately, I think managers that do well will be the ones that combine strong investment capability with low implementation friction. It's still a little early to know exactly how those economics will play out. The direction of travel seems fairly clear.
Do you find the fund managers, because I sort of remember many years ago when I was in distribution land, it was a little bit of spray and pray with distribution. There's as many appointments as you could get and seeing as many people as possible, but you're finding now that there's more data. People can be a lot more targeted and strategic with those distribution resources that they've got.
Oh, definitely, and we can cover this a little bit later on, but the more data sensitive or distributors that can harness that data are being more targeted. And that's where you're seeing improvements. But on the other hand, you're seeing more spend in technology. I think the whole distribution process is becoming much more targeted with more data availability.
We've always had a catch cry in our industry too about, past performance isn't a good indication of future performance, but it still plays a pretty big role, I feel, in getting advisors' attention, or at least getting managers on the attention list. But how are you seeing that at the moment with how big a factor it is relative to some of the other things we've just had a chat about?
Of course, performance still matters. It gets a fund manager into the conversation with decision makers and key advisors. But I think we can probably say that performance alone no longer guarantees implementation, and perhaps it never did. It certainly feels less sufficient today. Advisors are asking a broader question: does this strategy improve the client portfolio in a way that is easy to understand, easy to implement, and easy to defend? A strategy may look very strong in isolation, but still be unattractive if it's difficult to explain, report upon, or difficult to integrate into portfolio models. So I think the takeaway is fairly simple. Performance opens a door, but operational friction can close it. How is AI affecting this? AI is making it easier to compare managers, summarize research, analyze holdings, assess risk-adjusted returns. Information that once required direct access to the manager can increasingly be assembled much more quickly. Now, perhaps it's not always as accurate or nuanced at this stage, but clients certainly have a greater access to AI-enabled search and investment information that they did not have previously. That compresses some of the traditional informational advantages managers have had. It also raises the bar for clarity, consistency, and advisor support. So the challenge for fund managers, I think, Peter, is no longer simply providing more information. It's making sure that information is clear, accessible, and useful within the advisor's decision-making and portfolio construction process.
We're already starting to hear stories, Dennis, of advice firms, where clients are coming in with AI sort of generated portfolio reviews. So they're actually feeding their portfolios into an AI model and getting a report back, so the client almost comes out armed with a review pre-built. And this is obviously an edge case. It's probably more the very detail-oriented type clients that exist, but sort of that that access to information and not just information but insight and opinion has now been pretty much made available to everybody. Like, this is probably a broader challenge, I suspect, for advisors to manage too, that the client can actually get an assessment of their portfolio from an AI now that just wasn't possible in the past as well.
Yep. Yeah, definitely. So what about the downside? Could poor data quality impact that decision-making process for an advisor and a wealth group and their investment team?
Yeah, what we definitely see, again, probably back to my original points around platform usage, is that the businesses that, we deal with many who are those sort of $20 million plus revenue firms who have mostly grown through acquisitions. And they tend to inherit 4, 5, 6 platforms that they might be using across their client base, and they just haven't had the bandwidth to consolidate, or it's quite a laborious process to move money from one platform to another. And what that does create is a real heightened risk that the data that they're making decisions on, even just to get a single snapshot of their book, is challenging for some businesses, just to understand where the assets are. That's probably even more compounded if they're dealing with non-custody as well as wrap platform assets. So you're quite right. This is an area that a lot of businesses are still really grappling with. And whilst some of the major platforms have now released non-custody solutions to sort of coexist with that, we still find that it's an area businesses struggle with. So yeah, I would say certainly for responsible managers, AFSLs, investment committees, they still spend a huge amount of time just getting a handle on just where their assets are held at any given time at the moment. It's certainly not click a button at this stage for most, as well.
With the growth of platforms and platform influence and managed accounts, is there a risk of fund managers being disintermediated?
Yeah, I mean, we talk to fund managers all the time about this issue, where those decisions that are made by asset consultants have huge impact on their ability to distribute. So, and I suppose that since we've seen the managed account providers become quite powerful and scaled in their own right, so businesses like Evidentia is probably the best example. That's got so much scale now in what it does. 40 billion assets now, I think they're commanding. So that really does have a huge impact, and and certainly every business is somewhat different. But we do hear increasingly that the advice businesses will let the asset consultant managed account provider make a lot of the decisions on those elements, and probably not have as much input potentially. It does vary across the board. So I think that's absolutely happening right now, and so I would imagine that other than you have a really strong niche, compelling story, when you launch a fund, if you're not in those managed account models, you will probably struggle to get scale. But I suppose, that's not always a bad thing, because this is probably an area you would have expertise on, but quite a lot of managers and investment strategies that I understand have a capacity limit. They can only handle so much money. So even as those managed account providers grow, that I would have thought that it's going to be harder and harder for them to get alpha in their portfolios without finding new and interesting managers to partner with. So it can cut both ways, I suppose, in that regard as well. Yeah.
And which, broadly speaking, which kind of managers are most at risk of the growth of managed accounts and platform influence?
I would certainly say the more probably broader mainstream fund managers that don't have those unique elements to them, that aren't particularly specialists in a key field, that maybe would have just that would probably stick closer to an index type safe model. Those sort of things would be the ones who probably just don't get a look in. And even just talking to some managed account providers where they're trying to manage fees and all those elements as well. I'm sure we're seeing a lot of those asset classes going into straight index and those things as well, where possible to keep fees down. So the performance of the fees is probably held back for the managers generating huge alpha. Particularly, I'm assuming private markets, private credit's a good example of that, right? Where you sort of want to keep some ammunition ready to go for those managers where they'll add the most amount of value. So that's probably where we would see it. I mean, I think, and you might know this as well, but I would have thought private markets managers are, that creates opportunity for them potentially in this space, I would have thought.
Yeah, Peter, I think you raised a good point. Private markets are somewhat protected from commoditization because access and origination genuinely matter in that sector. Liquidity terms and manager skill certainly matter and differentiate more easily. And that makes aspects of private markets inherently more difficult to standardise and commoditise. There's also the information asymmetry in private markets compared to public markets. Advisors and wholesale investors still need specialist due diligence before allocating. So I think that probably slows the process compared with public markets, at least for the time being. But I don't think private markets sit outside this broader ecosystem shift. As allocations grow, platforms and research groups increasingly want to standard prepared, reported and monitored. So over time, even private market opportunities won't be entirely immune. What does that mean for private credit and other alternative managers? Strong performance and stable, attractive income may not be enough. Advisors will increasingly want to scrutinise aspects like reporting speed, loan book transparency, valuation practices, liquidity terms, platform access. A private credit fund might be appealing from an investment perspective, but still difficult to recommend if it's hard to explain and difficult to access information of the underlying investments, making it somewhat hard to fit into an advisor's portfolio process. And that creates an interesting dynamic, a slightly less distinctive strategy with better access, cleaner reporting and stronger advisor support may actually be easier to implement than a theoretically superior strategy with a lot of operational friction. So while investment capability remains critical in private markets, I think the ability to make that capability easy for advisors to access, understand and incorporate into their portfolios is going to become increasingly important.
I think, and one thing that probably hasn't been lost on us either, I've certainly been reading more and more industry reporting and certainly some messages from ASIC that, they're looking more closely into the managed account business models, looking more closely, particularly for those businesses that are both an AFSL and a managed account provider, whether they're in a related entity, so to speak, that's going to be the area of focus. And I suppose that will probably not, even no matter how you feel about that business model, it will probably put more scrutiny on the performance of those managers and how are they going relative to other, how are we demonstrating that we're performing appropriately. And I would have thought that that's going to put some interesting pressure on the entire business model to sort of say, if you're really just getting something close to the index and not generating much alpha, there will be more pressure, I think, on independent investment committees to sort of look at other options. And the other thing I've probably observed is we haven't seen, because the whole managed account industry is still really in its infancy to a large degree. We still yet to see significant shifts where large groups of IFAs move from one managed account provider to another because of performance. There's probably been a little bit of it, but we haven't seen huge amounts of it. So I would imagine for a lot of the managed account providers who have grown quite big businesses quite quickly, retention is going to be a really important piece of the puzzle for them in the next few years, I would have thought, around that stuff, particularly the ones that have raised capital on quite lofty valuations. So so I would have thought managers who can offer something a little unique would be probably better placed in that sort of environment.
Yep. Yeah, look, that's a great point. Just on compliance, what happens when there's a first sort of AI-related compliance failure, and what are the risks there?
Yeah, look, the reality is it's probably already happened and just no one knows about it just yet. So I suspect where we're seeing AI becoming a real risk is where advice firms in some cases are using AI from the very start to the very end of the advice delivery process. So They're using AI to record meetings, AI to extract data, AI to sometimes generate the advice itself. And I guess the risk with that is where you don't necessarily have what we would call a deterministic, source of data. You're really relying on an AI to extract a lot of data. There's just a heightened risk that one or two key bits of information is missing or is modelled incorrectly. And so I think certainly the larger licensees and more conservative advice businesses are taking a more mature approach to this, where they're just sort of combining AI with human in the loop to make sure that they're validating and checking data all the time. But the risk that we see, particularly in the smaller businesses, is that the AI is just so convincing that it's got it right, that it can make it really hard to see those areas where it may get wrong. So probably the key areas we would suspect that an AI could get things wrong is definitely on product replacement. So where potentially we have fees disclosed incorrectly because an AI model's read a PDS incorrectly or got something confused, and where they put in a statement of advice that's not, that isn't sourced correctly. Modelling of financial situations. So AI still has it's still getting better, but it's still not great at maths, particularly modelling long-term issues. So we have to be really careful around those elements. And I just think too, having incorrect client data. So we've made some false assumptions as well. So I think the problem for most licensees out there is the AI tools are just so accessible and easy to use that, and there's really almost no way you can actually get your arms around it to understand how they're being used. That I think it's only a matter of time before we have a complaint to AFCA. And from what I read, complaints are up quite a bit this year, probably due to Shield, but they are up quite a bit.
And AFCA is, Peter, maybe just tell the audience what that acronym stands for.
Yeah, so sorry, that's the Australian Financial Complaints Authority. So it's basically about, it's basically the place of last resort where you go to if an advisor or a product manufacturer has done let you down and you can't get a complaint resolved satisfactorily dealing with that provider, you end up at AFCA, and that's sort of what. And I'd say certainly an area where I think high quality information is a really important element to this too. So in many cases, people are just scraping the internet for this information, and so I think fund managers probably need to think a little differently about how they provide access to information for advisors, where they're using AI as a research partner. And so I even know some fund managers that are putting more information publicly because they just realise that if it's behind not a paywall, but a password wall, then it's more likely that an AI will go and find something which isn't correct. So you're almost better off putting more out there, I think, and having the right information accessible than risking an AI getting it wrong, frankly. And even from a data point of view, we hear more and more stories of people, advice firms building their own little bits of software, vibe-coded sort of software, which is where you effectively get an AI to generate a software for you, and they're feeding it with PDSs and fact sheets and all these sort of bits of information and doing their own research on the back of it. And as you would be all well aware, most fund managers have quite complex fee structures, multiple versions of the same fund, different classes. These are all areas that an AI can get wrong really easily. So these are the things I think are really high risk for us right now. So I guess I'm kind of curious because I know distributions it's a real specialist field, and the wholesale distribution model's quite mature now. Like, it's been quite a successful business model for many years. I mean, do you sort of see that as with AI and those things we just discussed today, do you still see that that business model can survive in the future with the way things are?
Yeah, thanks, Peter, and you flatter us. But look, I think it's evolving. It's not going to become obsolete. AI can help to automate a lot of the processes which go into prior to reaching out to a prospect. So that's very helpful. We also have to become aware, and as you touched on before, advisors are increasingly consuming information through webinars, podcasts, platform content, other sort of AI-assisted workflows. So, as I said, we have to be sensitive to that. Access to information, assuming the information is correct, is becoming less valuable. So I think distributors just have to think hard, where they can add value going forward. I think more technical ability around investments. I think better knowledge about platforms and managed accounts and how they operate and the mechanics behind them is going to be increasingly important. I suppose one question many people would ask is, would headcount and team structure change in this new environment? It's difficult to say. I think maybe an easy answer is just to say there probably won't be less people, but it'll just be different teams constituted by distributors and BDMs and other client-facing people, which are probably more educated in some of those areas that I just mentioned. And then different kind of roles might be created in a more tech enabled environment. So not necessarily less people, probably different type of people and different team structures.
Yeah, I would have thought certainly, one of the first questions a lot of people used to ask was, that old tell me about your business question. And I think in 2026, that's an unforgivable question to ask pretty much anyone now with AI. You should actually know more about their business before they've even gone, you go and see them because of the amount of data you've got. So I would have thought that's probably the sort of value that wholesale model gives people, because you've got those market insights and relationships already ready to go. That's not, the relevance of that just isn't important anymore. It's actually what you deliver when you're in the door. Yeah.
Yep.
Totally. Yeah.
Last question, Peter. In a world of we keep hearing about rising tech costs, and who's ultimately going to pay for all this in our ecosystem?
Well, the easy answer is the client, the investor. They pay for all of us. But I suppose to break down the value chain a little more specifically, we've got this sort of constraint with 15,000 financial advisors in Australia that we know we probably won't grow those numbers much more, it'll be quite a slow road back to anything more meaningful than that. So I think a lot of the ecosystem, be it platform providers, managed account providers, even businesses like ourselves, are laser focused on how to get those advisors serving more clients. That is ultimately the only way this market continues to grow. I do believe that just the compounding growth of our market, the funds under management, the projections are quite eye-watering when you see what the market could look like by 2040. And so I think we'll all win out of that to an extent. But the only reason we win is, quite frankly, because those client asset pools just continue to grow at a huge rate. So I would say that the client will always pay for as much of this as possible, but I probably show a bit of recency bias here, but I do ultimately think it's probably the platforms who are probably the best placed to do this, because they are, they bill the client directly for the administration. They have the scale benefits already. They're particularly the two majors, Hub and Netwealth, they're listed. They've got big market caps and balance sheets to reinvest, and they've almost got a bit of a flywheel happening where they're in a really good position to service those advisors with technology. So simple answer is the client pays, but the more nuanced answer is I still feel that the platforms will play a pretty major role in providing more tech to the ecosystem, which benefits both the advisor and the client, quite honestly, in that side as well. So that's why I still feel, from a funds management perspective, that the relationship with those platforms is going to be, pretty critical for a long time, in my opinion. Yeah.
Thanks, Peter.
Thank you, Dennis.